Right now, something important is discussed. The market everyone trusts to reflect true value is quietly failing unnoticed. A single $650 million silver purchase has just occurred, shaking confidence and revealing forces that most people cannot see. The disturbing question is this: who has the resources, timing, and motive to move markets without revealing themselves publicly? Silver is no longer a simple commodity or hedge. It is a critical asset influencing both industry and global finance. Historically, silver has been undervalued and indispensable, quietly shaping economies, powering technologies, and controlling hidden aspects of global wealth. Paper markets have long masked real scarcity, creating an illusion of abundance that can vanish instantly under physical demand pressure. The origins of silver's tensions stretch back decades. When governments stripped silver of monetary value after World War II, central banks hoarded gold, undervaluing silver while industrial uses quietly increased, creating invisible strategic importance for knowledgeable investors. Over time, electronics, solar, renewable technologies transformed silver from a hidden asset to an industrial necessity globally. Key financial and industrial figures have long understood silver's dual identity, which creates unique vulnerabilities in supply and pricing. Futures, ETFs, and synthetic derivatives expanded paper supply far faster than physical silver could ever support reliably. The system relied entirely on confidence, as long as investors did not demand physical delivery. Markets functioned without disruption. Industrial demand accelerated quietly, while financial markets continued to undervalue silver, keeping prices artificially low despite rising scarcity. Solar panels, electric vehicles, and high-tech electronics consume silver at rates unseen historically, permanently reducing available physical supply. Unlike oil or gas, silver is lost in micro quantities across millions of devices, permanently lowering inventory levels slowly. Markets mispriced scarcity for years, keeping paper prices low while physical demand quietly accumulated in private hands. The breaking point occurs when physical demand collides with leveraged paper markets, creating bottlenecks, rising premiums, and stress signals. The $650 million purchase is exactly this type of shock, revealing both physical scarcity and market asymmetry simultaneously. Fallout rarely remains confined to a single sector. Silver underpins energy, manufacturing, and technology infrastructure globally. Sudden accumulation or price stress cascades through contracts, financing arrangements, and derivative positions across international markets. Confidence in paper markets collapses quickly when physical metal is demanded, triggering rapid repricing and systemic volatility. Failed fixes are predictable. Expanding paper supply or suppressing volatility only delays inevitable adjustments caused by physical scarcity. Physical silver cannot be created instantly. Cycling is slow, mining output fixed, and substitutes degrade industrial performance significantly. Interventions that ignore scarcity postpone corrections but do not prevent violent market resets that eventually occur. Modern parallels are striking. Central banks flood liquidity while industrial demand continues to rise unchecked across multiple sectors. Derivatives, margin accounts, and algorithmic trading amplify volatility, allowing sudden purchases to trigger systemic adjustments rapidly. The $650 million transaction signals insiders repositioning ahead of an anticipated market correction. Unseen by casual observers, inventory data is thin, premiums are rising, and settlement times are lengthening, classic warning signs ignored by most participants. Paper contracts still trade normally, but they increasingly fail to reflect physical reality, making real price discovery inevitable. When the disconnect becomes obvious, pricing shifts instantly to those controlling actual silver, leaving leveraged traders exposed. Repeating patterns from previous crises provide a roadmap: calm, denial, minor shocks, panic, interventions, and eventual systemic repricing. In silver, these dynamics have existed for decades, quietly building under the surface until significant transactions expose imbalances. Understanding cause and effect is critical. Industrial demand reduces supply, paper leverage magnifies losses, and system-wide corrections propagate quickly. The market is responding rationally to fundamental pressures ignored for years, not irrational panic or sentiment alone. The identity of the buyer matters because it reveals capacity, strategy, and the ability to influence prices intentionally. Motives may include hedging, industrial exposure, protecting monetary reserves, or leveraging scarcity to control future supply chains. History shows secret accumulation often precedes major repricing events, providing early advantage to those positioned strategically. Takeaways are clear. First, silver is no longer secondary, but a systemic pressure point influencing finance, industry, and technology. Second, paper markets are increasingly disconnected from physical reality, and price discovery favors holders of actual metal eventually. Third, significant purchases like $650 million are not casual trades but strategic signals of structural market tension. The warning is simple. Markets can appear calm while imbalances silently grow, making sudden resets dangerous and inevitable. Resets rarely announce themselves. They unfold in phases rewarding preparation and punishing those who remain complacent or reactive. Investors ignoring both physical and paper markets risk being caught on the wrong side of sudden large adjustments. The open-ended question remains, who is the secret buyer, and what does this move signal for global silver markets? Are we witnessing defensive accumulation, preemptive positioning, or a precursor to a broader market reset happening quietly? The truth will likely unfold over weeks or months, but the signal is already evident to careful observers. Understanding these dynamics allows investors to hedge, reposition, or act ahead of volatility rather than reactively scrambling. Observing supply chains, industrial demand, and settlement anomalies provides insight invisible to most traders in the market. Those recognizing early warning signs can navigate markets successfully, while others struggle with chaos once it becomes public. Subscribe now to stay informed about critical financial moves, hidden market signals, and forces shaping the future of silver strategically. Knowing early can mean the difference between opportunity and loss. When systemic imbalances reveal themselves suddenly to the world,